Have you ever looked at your bank account and felt like, despite all your hard work, something just isn't clicking? What if the real barrier holding you back from building wealth isn't the economy or your job, but something hidden inside your own mind? Let me ask you something. Why exactly aren't you wealthy yet? No, I'm serious. Really think about it for a second. You're smart. You put in the hours. You know deep down that you ought to be saving more, investing more effectively, and making smarter choices. So, why isn't it connecting? Why are people who seem less intelligent than you managing to build wealth while you're still just trying to keep up? Why does that person down the street who barely got through high school seem to have more money than you do? Why are you consuming articles, watching content, trying to learn, and still not moving forward? Here is the answer that most people don't want to accept. Your own brain is actively sabotaging you right now, every single day. It's pushing you to do things that feel correct but are actually keeping you poor. And the absolute worst part about it is that you don't even realize it's happening. You operate under the assumption that you're making rational decisions. You believe you're being smart about your finances, but you aren't. Your brain is running on ancient software that was designed to keep your ancestors alive in the jungle. It wasn't designed to make you rich in the modern world. And until you grasp how your own mind is actively working against your interests, you'll just keep working hard and staying broke. It turns out that success has almost nothing to do with how smart you are, how hard you work, or even how much money you start out with. It has everything to do with how you think. The people who manage to get rich think differently. It's not because they're geniuses, but because they understand the psychological traps that keep everybody else poor. And they've figured out how to sidestep them. So today, I'm going to show you exactly how your mind is keeping you in a state of being broke. This isn't going to be vague advice or feel-good nonsense, but the actual mental mistakes you're making right now that absolutely guarantee you'll never build real wealth. And, more importantly, I'm going to show you how to fix them. Here's the first way your brain is screwing you over. You are terrified of losing money. I mean truly, deeply terrified. It's a stronger feeling than your desire to make money. Scientists have proven this. They refer to it as loss aversion. Losing $100 hurts approximately twice as much as gaining $100 feels good. Just think about that. Your fear of a loss is literally 2 times as powerful as your desire for a gain. And this is absolutely killing your ability to build wealth. Because here's what happens. You are so frightened of losing that you refuse to ever take intelligent risks. You keep your money parked in a savings account that earns almost nothing because at least you won't lose it. You sell off your winning investments way too early because you're scared they'll dip and you'll lose the profit you made. You hold on to your losing investments for far too long because selling them would mean having to admit the loss and face the pain of being wrong. Every single one of these decisions feels safe. It feels smart, but they are all wrong. And they're all triggered by the exact same psychological trap. Your brain values avoiding a loss more than it values gaining wealth. So you wind up avoiding gaining wealth. So you wind up avoiding the very behaviors that would actually make you rich. Let me give you a concrete example. Let's say you have 2 opportunities for an investment. Option A is a guaranteed return of $5,000. Option B is a 50-50 chance of either making $10,000 or making nothing at all. Most people will choose option A. It feels safer, right? But mathematically, they are identical. The expected value of both choices is $5,000. But your brain's fear of the zero outcome, the loss, makes you choose the guaranteed smaller amount. Now, let's flip it. Option A is a guaranteed loss of $5,000. Option B is a 50-50 chance of either losing $10,000 or losing nothing. Now, all of a sudden, most people pick option B. They gamble just to avoid the certain loss, even though it's technically riskier. Your brain is inconsistent. It makes you risk-averse when you're looking at gains, and it makes you risk-seeking when you're looking at losses. And both of those tendencies are costing you money. The folks who actually manage to build wealth have figured out how to override this exact instinct. They've trained themselves to look at risk in a totally different way. They don't ask, how much could I lose? Instead, they ask, what is the probability and what is the adjusted expected return? They take calculated risks that have much more upside than downside. They don't panic and sell everything when the market takes a nosedive. They don't hold on to losers, just hoping they'll magically come back. They think rationally about risk instead of reacting emotionally. And here's a concept most people just don't get. Not taking a risk is, in itself, incredibly risky. If you keep all your money in cash because you're too scared to lose it in the market, inflation is slowly eating it alive. You might feel like you're being safe, but what you're actually doing is guaranteeing that you will be poorer in the future. Real safety isn't about avoiding all risk. It's about taking smart risks where the odds are stacked in your favor over the long run. Here's another trap. You just do whatever everyone else is doing. You can't help it. Your brain is hardwired to follow the herd. It's a survival mechanism from when we lived in small tribes. If everyone in the tribe starts running, you'd better run too. Don't stop to think, don't ask why. Just follow. That instinct kept your ancestors alive when a tiger was nearby. But in modern markets, it keeps you broke because the crowd is almost always wrong about money. When everyone is buying stocks, that's precisely when they're expensive. When everyone is buying real estate, that's when it's overpriced. When everyone says crypto is heading to the moon or that tech stocks simply can't lose, that is the exact moment the smart money is getting out. But you don't get out. Your brain sees everyone else making money and it screams at you, buy now or you'll miss out forever. So you buy right at the top. Everyone's excited, everyone's making money. It feels safe because you're doing what everyone else is doing. Then reality hits. The market crashes. Now everyone is panicking and selling. Your brain sees everyone losing money and screams, sell now before it gets any worse. So you sell at the bottom. Buy high, sell low. It's the perfect formula for staying poor. And it's all because you're letting the crowd make your decisions instead of thinking for yourself. I'll tell you something that's painful to hear. It is hard to go against the crowd. I mean, really hard. It's not just intellectually difficult, it's emotionally difficult. When everyone around you is getting rich and you're just sitting on the sidelines because you think prices are too high, it hurts. You feel stupid. You feel like you're missing the boat. People will call you an idiot. They'll show you how much money they're making while you're doing nothing. The psychological pressure to join in with the crowd is intense, almost unbearable. But that is exactly when you have to resist, because crowds are wrong at the extremes. When it feels the most painful to be different, that's usually when being different is the most profitable. When everyone thinks you're crazy for not buying, that's when prices are too high. When everyone thinks you're crazy for buying, that's when prices are low. The people who get rich are the ones who can handle the psychological pain of being a contrarian, of watching everyone else make money while they wait, of being called an idiot right up until the moment they're proven right. Think about every market bubble in history. The dot-com bubble, the housing bubble, the cryptomania. Every single time, the majority was convinced that prices would just keep going up forever. Everyone had a story about why this time is different. And anyone who said it looked like a bubble was mocked, dismissed, or told they just don't understand the new paradigm. Then it crashed. And all those people who were getting rich suddenly lost everything. Your brain wants you to be part of the crowd, because being different is psychologically painful. But that psychological pain is the price of admission for wealth. You either pay it by being contrarian when it feels hard, or you pay a much bigger price by following the crowd right off a cliff. Here's another one that's probably costing you money this very minute. You value today way, way more than you value tomorrow. Psychologists have a name for this: present bias or hyperbolic discounting. $100 today feels real, tangible, and valuable. You can hold it, you can spend it, you can enjoy it right now. $1,000 10 years from now feels abstract, distant, almost like it's not real. Intellectually, you know that's wrong. But emotionally, psychologically, your brain just can't help itself. This is the reason you can't save money. It's not because you don't want to. It's not because you don't know you should. It's because spending money today feels good, and saving money for 30 years from now feels like nothing. The pleasure of buying something new today is immediate and intense. The pleasure of having money 3 decades from now is abstract and weak. So, you spend. You spend on things you don't need, on experiences that don't really matter, on stuff that feels important in the moment but is meaningless a week later, and you stay poor. Let me paint a quick picture for you. You're thinking about buying a new car. You don't actually need it. Your current car works just fine. But this new one, it's nice. It would feel good to drive it, to show it off, to have that new car smell. That's immediate gratification. Your brain can almost taste it. Now, compare that to this thought. If I don't buy this car and instead invest that $30,000, in 30 years it could be worth $200,000. Which feeling is stronger? The immediate pleasure of the new car, or the abstract concept of money 3 decades down the line? For most people, the car wins every single time because your brain is wired to heavily discount the future. $200,000 in 30 years feels like less value than $30,000 of immediate pleasure. That's completely insane if you think about it rationally. But that is exactly how human psychology works. And it keeps you poor. The people who get rich have figured out a way to make the future feel real. They've trained their brains to value tomorrow almost as much as they value today. How do they do it? By calculating, by making it concrete. Every time they're tempted to spend money on something silly, they calculate what that money would be worth in 20 years if they invested it instead. They write it down. They visualize it. They make the future tangible and real. And all of a sudden, delayed gratification becomes a whole lot easier. I'll give you an exercise. The next time you want to buy something expensive that you don't really need, do this calculation. Take that amount of money. Assume an 8% annual return over 20 years. Write down what it would be worth. That $1,000 purchase, that's $4,600 in 20 years. That $30,000 car, that's $140,000 in 20 years. Now, the decision becomes real. You're not choosing between a car today and some abstract future money. You're choosing between a car today and $140,000 in 20 years. Which one do you want more? Most people never do this calculation, so their brain never has to face the real trade-off. They just spend, and then they wonder why they never get ahead. Start making the future real, and just watch how your spending habits begin to change. Let me show you another mental trap. You only see what confirms what you already believe. This is called confirmation bias. Your brain doesn't want the truth, it wants to be right. So, once you believe something, your brain actively goes looking for evidence that supports it and completely ignores everything that contradicts it. You're not doing this consciously. It's automatic. Your brain is literally filtering reality to support your existing beliefs. You think you're smart, so you only remember your good decisions and conveniently forget the bad ones. You think real estate always goes up, so you notice every single article about rising prices and ignore every single warning about bubbles. You think you're a good stock picker, so you remember the 3 stocks that doubled and forget about the 7 that went to 0. Your brain is literally lying to you about your own track record, and you believe it, because the lie feels better than the truth. Here's how this plays out in real life. You buy a stock because you believe the company is undervalued. The stock goes down. Do you reconsider your analysis? No. Your brain goes looking for reasons why you're still right. The market is wrong. It's temporary. Other investors just don't see what you see. Your brain finds articles and opinions that support your view and ignores everything else. So, you hold the stock. It keeps going down. Your brain keeps finding reasons why you're right. You lose 50%, 70%, 90%, and the whole time your brain was protecting you from the truth. You were wrong. This is deadly for wealth building, because if you can't see your own mistakes, you'll just keep making them. If you can't update your beliefs when reality changes, you'll hold bad investments forever. You'll keep using strategies that don't work. You'll stay stuck in patterns that keep you poor because your brain won't let you see that they are not working. The people who get rich are brutally honest with themselves. They keep track of their mistakes not in their head where their brain can rewrite history, but actually written down. They do postmortems on their bad decisions. What did I believe? Why did I believe it? What actually happened? Where was my thinking wrong? They actively seek out information that contradicts their beliefs because they know their brain won't show it to them naturally. This is how you get better. That's how you stop repeating the same mistakes. But most people can't do this. Their ego just won't let them. So they make the same financial mistakes for 40 years and wonder why nothing ever changes. Here's one that's costing you money every single day. It's called anchoring. Your brain latches onto the first number it hears, and everything else is judged relative to that anchor. This happens automatically. You can't stop it, but you can be aware of it and correct for it. You bought a stock at $50. Now it's at $30. You won't sell because you're anchored to $50. You're waiting for it to get back to where you bought it. In your mind, you haven't really lost money until you sell. So you hold on, hoping it recovers. But the market doesn't care what you paid. The only question that matters is this a good investment at $30? Would you buy it today at this price? But you can't think clearly because you're anchored to that $50 price in your head. That's your reference point, and it's completely irrelevant. Or you're shopping for a car. The salesman shows you one for $40,000. That's your anchor. Then he shows you one for $35,000. Your brain thinks you're getting a deal because it's $5,000 less than the anchor. You feel smart. But maybe that car is only worth $30,000. You're overpaying, but you feel like you're winning because you beat the anchor. The salesman knows this. That's why he showed you the expensive one first. He set your anchor high so that everything else looks like a deal. This happens with salaries. The very first number mentioned in a negotiation becomes the anchor. If you say, I'm currently making $60,000, that becomes the anchor for the negotiation. If they say, this position pays between $60,000 and $80,000, that becomes the anchor. Whoever sets the anchor has a huge advantage. This happens with houses. The asking price is an anchor. Even if you know it's overpriced, that number is now stuck in your head. An offer of 10% below asking feels like you're getting a deal, even if it's still 20% above fair value. The way to beat anchoring is to completely ignore the first number you hear. Wipe it from your mind. Then do your own analysis from scratch. What is this really worth? Not what someone is asking, not what you paid, not what it was worth last year. What is it actually worth today? That's independent thinking. That's how you avoid the mental trap. Here's another one. Sunk costs. This might be the single most expensive psychological mistake that people make. You've already spent money or time on something, so you feel obligated to continue, even when it's clearly a bad decision going forward. You're emotionally attached to money that's already gone, and that attachment is costing you a fortune. You've been in a career for 5 years that you hate, it doesn't pay well, you're miserable, but you don't quit because I've already invested 5 years. I can't just throw that away. Those 5 years are gone. They're a sunk cost. The only question that matters is, what should you do from here? If the answer is find a better job, then do it. The 5 years you already spent are irrelevant. But your brain can't see it that way. Your brain treats those 5 years as an investment that would be wasted if you quit. You put $10,000 into a failing business. It's not working. You're losing money every single month, but you keep putting in more money because I've already invested $10,000. If I quit now, I'll lose it all. That $10,000 is already lost. Putting in more money won't bring it back. It will just mean you lose $20,000 instead of $10,000. But your brain can't accept the loss. So, it throws good money after bad, trying to avoid admitting the original investment was a mistake. You bought a stock at $100, it's now at $20. You refuse to sell because if I sell, I lock in the loss. But if I hold, it might come back, it might. Or it might go to zero. The question isn't whether you've lost money. You have. The question is this stock worth $20 right now? Would you buy it today at $20 if you didn't already own it? If the answer is no, then sell it. But most people are psychologically trapped by the sunk cost of their original investment. The rich understand this. When an investment goes bad, they sell. When a business isn't working, they shut it down. When a strategy stops working, they change it. They don't care how much they've already invested. That money is gone. The only question is, what's the smart move from here? That's rational thinking. That's how you build wealth. And here's one more that's keeping you poor. Overconfidence. Your brain thinks you're better than you actually are. This isn't arrogance. This is just human nature. Studies show that 90% of drivers think they're above average. That's mathematically impossible. 70% of high school students think they're above average in leadership ability. 94% of college professors think they're above average at their job. Everyone thinks they're special, smarter, better, different. So, you read a few articles about investing. You pick 3 stocks. 2 of them go up. Your brain concludes, I'm good at this. I have a talent for picking winners. You don't. You got lucky. But your brain can't tell the difference between skill and luck when the sample size is that small. Now you're confident. You start taking bigger risks. You invest more money. You ignore advice because you think you know better. You expand into areas you don't understand because you think your intelligence will figure it out. And eventually, reality hits. Your talent disappears. Your picks start losing money. But by then, you've invested so much that the losses are catastrophic. Your overconfidence cost you everything. And the worst part is, you still don't see it. Your brain still thinks you were right and just got unlucky. So you'll do it again. Or you start a business in an industry you don't understand because you think you're smart enough to figure it out. Everyone else who failed just wasn't as smart as you. You're different. You're special. You're not. 90% of new businesses fail within 5 years, and most of those founders thought they were special too. Or you think you can time the market because you successfully sold before a crash one time. You can't. You got lucky. Timing the market requires being right twice. When to get out and when to get back in. Even if you're right once, you'll probably be wrong the second time. But your overconfidence won't let you see that. The antidote is intellectual humility. It's knowing what you don't know, actually writing down your areas of ignorance and staying the hell out of them. We have passed on thousands of investment opportunities simply because we didn't understand them, not because they were necessarily bad. Some of them would have made us even richer. But we passed because we knew the limits of our own knowledge. We knew that confidence outside of your competence is just arrogance, and arrogance is expensive. Here's a simple test for you. For every investment or business decision you make, write down 3 reasons why it might fail. If you can't think of 3 good reasons, you are being overconfident. You're not seeing the risks. Your brain is showing you all the ways you'll win and hiding all the ways you'll lose. Force yourself to see the downside. Force yourself to be a pessimist about your own ideas. That's intellectual humility. That's how you avoid catastrophic overconfidence. Now, let me tell you about the most wealth-destroying emotion there is. It's envy. It's not greed. Greed, at least, points you toward wanting more for yourself. Envy makes you care about what other people have, and that is poison for building wealth. You see your neighbor buy a new car. You suddenly feel inadequate. Your car, which was perfectly fine yesterday, suddenly feels old and embarrassing. So, you go out and buy a new car you can't afford, just to keep up. Your coworker gets a promotion and starts talking about his salary. You feel poor in comparison, so you spend more on clothes, on restaurants, or on a nicer watch just to feel successful again. Your friend posts vacation photos from Europe. You feel like you're missing out on life, so you book a vacation you can't afford and put it on a credit card. None of these purchases made you happier. You didn't even want them until you saw someone else had them. You're not buying based on your own needs or desires. You're buying based on comparison, based on keeping up, based on not feeling inferior. Envy has turned you into a spending machine, and it is keeping you broke. The insidious thing about envy is that it's just a treadmill. There is always someone with more. You buy a nice car, but your neighbor has a nicer one. You get a promotion, but your friend got a bigger one. You go on a vacation, but someone else went somewhere more exotic. The hedonic treadmill never stops. You're running faster and faster just trying to keep up, and you never arrive because there's always someone ahead of you. Meanwhile, all the money you're spending trying to keep up is money that's not being invested, not compounding, and not working for you. You are sacrificing your actual future wealth for the appearance of current wealth, and the appearance doesn't even make you happy. Studies show that people who care more about relative status are less happy than people who focus on their own absolute well-being. The people who get rich have killed this instinct. They genuinely don't care what other people have or what they think. They don't need external validation. They aren't competing with their neighbors or their coworkers or their friends. They have defined success on their own terms, and they are living according to those terms. That is incredibly hard to do. The social pressure to keep up is enormous, but it's necessary because you cannot build wealth and play status games at the same time. You have to choose. That's the secret. Define what enough means for you, reach it, and then stop competing. Let me give you one final trap. You love stories. Your brain is a story-making machine. It wants everything to fit into a neat narrative, causes and effects, reasons why things happen, heroes and villains, simple explanations. But reality is messy, complex, and random. Most things do not have simple explanations, but your brain can't accept that. So, it makes up stories. And those stories feel true, even when they're complete fiction. The stock market goes up 10%. Your brain creates a story. The economy is strong. Consumer confidence is up. The Fed's policies are working. The market goes down 10%. New story. Investors are worried about inflation. Geopolitical tensions are increasing. Recession fears are growing. The next week, the same exact facts exist, but the market does the opposite. Your brain creates a completely different story to explain it. These stories feel like understanding. They feel like you know why things happened, but you don't. You're just pattern matching after the fact. You're creating narratives to explain random short-term noise. And those narratives are dangerous because they make you think you can predict what happens next. You can't. This is why people lose money listening to financial news. Every single day, there's a confident explanation for why the market did what it did. Stocks rose today on strong earnings reports. Stocks fell today despite strong earnings reports. The same data gets spun into opposite narratives depending on what the market did. And it all sounds so logical, so convincing, but it's mostly just storytelling. It's randomness with a narrative grafted onto it after the fact. The problem is, your brain learns from these stories. It creates rules. When earnings are strong, stocks go up. But that's not actually true. Sometimes strong earnings lead to sell-offs because they weren't strong enough relative to expectations. Your brain oversimplifies. it creates false patterns, and then you make decisions based on those false patterns and lose money. The rich learn to ignore stories. They focus on fundamentals, on actual business value, on long-term trends that actually matter. They don't care what story the market is telling today. They don't care what explanation the financial news has for short-term movements. They know it's mostly noise. They know that what matters is the actual value of businesses over years and decades, not the stories people tell about daily price movements. Now, here's what you need to understand. Just knowing about these biases doesn't automatically fix them. You can understand every single trap I just described and still fall right into them. Why? Because these biases are emotional, not intellectual. They happen fast, automatically, below your conscious awareness. Your rational mind is slow and lazy. It takes effort to engage it, and most of the time you're just running on autopilot. Your intuitive brain is making decisions based on emotions and patterns. And your rational brain only gets involved if you force it to. So, you need systems. You need ways to force your rational brain to check in on your intuitive brain before you make important decisions. Let me give you some practical tools. First, never make a financial decision in the heat of the moment. Never. I don't care how good it looks. I don't care if you think you might miss out. Wait at least 24 hours. Sleep on it. Because your intuitive mind might be caught up in the excitement, in the fear, in a compelling story, or in social proof. But after sleeping on it, your rational mind gets a chance to engage, to analyze, to check for biases, and to think it through properly. Second, keep a decision journal. Before you make any significant financial decision, write down why you're doing it. What do you believe? What are you assuming? What would have to be true for this to work out? What could go wrong? Then, months or years later, go back and review it. Were you right? Were you wrong? Where was your thinking accurate and where was it flawed? This is how you get better. This is how you identify your personal biases and learn to correct for them. But most people never do this. They make decisions, forget what they were thinking at the time, and never learn from their mistakes. Third, create a checklist. Before making any significant investment or financial decision, go through a written list of questions. Am I being influenced by what everyone else is doing? Am I anchored to some irrelevant number? Is this based on actual value or just a compelling story? Am I holding on just because of sunk costs? Am I overconfident about something I don't fully understand? Am I doing this because of envy or comparison? These questions force your rational brain to engage. They override your autopilot. Fourth, practice saying no out loud. Say it to yourself. Say it to others. Train yourself to default to no. Unless something is obviously, overwhelmingly good, it's a no. Most opportunities are bad or just mediocre. If you default to no, you'll avoid most of the mistakes. If you default to yes, you'll be buried in mediocrity and losses. Saying no feels bad in the moment because of that fear of missing out. But saying yes to the wrong things feels so much worse over time. Fifth, deliberately seek out people who disagree with you. Your brain naturally wants confirmation. So, you have to artificially create some contradiction. Before you make a big decision, find someone smart who thinks you're wrong, and then listen to them. I mean, really listen. Don't just wait for your turn to argue. Try to understand why they see it differently. What do they know that you don't? What are they seeing that you're missing? This is going to be incredibly uncomfortable. Your brain will hate it, but it's essential because your brain is lying to you, showing you only what confirms your beliefs. You need someone to show you the other side. Sixth, keep a failure log. Write down every single financial mistake you make, and not in general terms. Be specific. What did you do? Why did you do it? What went wrong? Which bias or psychological error led to the mistake? Over time, you'll start to see patterns. You'll notice that you make the same types of mistakes over and over. Maybe you always hold losers too long. Maybe you always follow the crowd. Maybe you always spend based on envy. Once you can see your personal patterns, you can create specific safeguards against them. And here's the most important thing. Start small. Don't try to fix your entire psychology all at once. Pick one bias. Maybe it's loss aversion. For the next month, just notice every time you make a decision based on the fear of loss rather than the probability of gain. Just notice it. That's all. Don't try to change it yet. Just become aware of when it's happening. Once you can see it, then you can start to override it. But you have to see it first. The key insight here is this. Getting rich is not about knowing secrets. It's about thinking correctly. And thinking correctly is not natural. Your brain is literally wired to keep you poor. It's wired to make you follow crowds, fear loss, spend today, believe stories, and stay overconfident. Every single day, your psychology is sabotaging your wealth. These aren't character flaws. They're human nature. Everyone has these biases. The only difference is that some people are aware of them and have built systems to override them. And those are the people who get rich. You now know how your brain is sabotaging you. You know the specific traps. You know why you make the financial mistakes you make. And you know how to build systems to protect yourself from your own psychology. That's more than 99% of people ever learn. Most people go through their entire lives being controlled by their biases without ever understanding what's happening. So now, you have a choice. You can ignore all of this. You can keep operating on autopilot, keep making the same emotional, intuitive decisions that feel right but keep you poor. Or you can do the hard work. You can build the systems. You can override your brain's natural tendencies. You can think like the rich think. Not because you're smarter than everyone else, but because you understand psychology. That's the real secret. That's what separates the people who build wealth from the people who stay broke their entire lives. It's not intelligence. It's not hard work. It's not luck. It's just better thinking. And now you know how to think better. So go build your systems, override your biases, make decisions with your rational brain instead of your emotional brain, and just watch what happens when you stop sabotaging yourself and start thinking clearly about money. The psychology of getting rich isn't complicated, but it is hard. It's hard because it requires you to go against your very nature, against your intuition, against what feels right. But that discomfort, that psychological pain of thinking differently, that's the price of wealth. You either pay it or you stay poor. There is no third option. Choose wisely. That choice sounds simple, but it's the hardest part because all those systems, the checklist, the journal, the 24-hour rule require effort. And your brain, beyond just being ancient, is also fundamentally lazy. It wants the path of least resistance. It wants what's easy now. That's why building wealth is less about a single brilliant move and more about winning 1,000 tiny, boring battles against your own impulses, day after day. Let's dig into another layer of this. So many of these biases we've talked about, loss aversion, present bias, even envy, are rooted in something deeper. They're symptoms of a scarcity mindset. This is the core belief that there's a limited pie. The belief that if someone else gets a big slice, there's less for you. That resources are dwindling and you're going to run out. When you operate from scarcity, your entire focus is on defense, on not losing, on hoarding. A scarcity mindset is what makes you drive 30 minutes to save $3 on gas. You feel smart, like you won. But you just spent 30 minutes of your most valuable asset, your time, to save $3. Your brain's bandwidth was consumed by a low-value decision. Meanwhile, you didn't spend that 30 minutes learning a skill that could earn you an extra $5,000 or negotiating a $10,000 raise. You're so focused on saving pennies that you miss the opportunities to earn dollars. This mindset also makes you terrified to spend money on growth. You see a $1,000 course or a $500 ticket to a professional conference, and your brain screams, "That's $1,000 gone." It sees it only as a cost, as a loss. It can't process the idea that spending that $1,000 could be an investment that returns $50,000. Scarcity tells you to protect what you have at all costs, which guarantees you'll never have much more. The opposite of this is an abundance mindset. This isn't some magical thinking that says you can wish for $1,000,000. It's the simple, practical belief that value can be created. It's not a zero-sum game. Just because someone else built a successful business doesn't mean you can't. Just because your friend got a promotion doesn't mean there are no promotions left for you. In an abundant world, you can bake a new pie. When you shift to this mindset, your behavior changes. You stop seeing other people's success as a threat, which kills envy. You start seeing it as inspiration, or even as an opportunity to collaborate. You stop focusing only on saving and start focusing on earning. You become willing to invest in yourself, in your skills, your network, your health, because you see that as the engine of your wealth, not as a drain on it. You're still smart with your money, but you're playing offense, not just defense. This connects directly back to that idea of defining enough. The scarcity mindset hates the idea of enough because it believes you'll never have enough. The hedonic treadmill we talked about is scarcity in action. It's the constant fear that you'll be left behind. But the most powerful psychological tool in your entire arsenal is to actually sit down and calculate your enough number. Not a fantasy number, but a real one. What does it cost for you to live a life you truly value? What's the price of freedom from financial anxiety? Maybe it's $1 million, maybe it's $2 million, maybe it's 800,000. The actual number doesn't matter. What matters is that you have one. Because the moment you have that number, you've defined the finish line. You're no longer in an infinite race against everyone else, a race driven by envy and stories. You're in a finite race against your own goal. And suddenly, all the other noise fades. Your neighbor's new car doesn't matter because it doesn't get you to your number. The hot stock story doesn't matter because your plan is built on systems, not gambles. This is the ultimate psychological victory. It's not just overcoming your biases, it's making them irrelevant. You're no longer a participant in the mass delusion. You've created your own game with your own rules and a finish line you can actually cross. That is the real wealth. That is the real freedom.